Welcome to the deep dive. We've just spent some time digging into the Affirm Holdings Q1 fiscal 2026 earnings call. And the first impression, a company really focused on durability, disciplined growth.
Yeah, definitely.
But before we even get to the numbers, there was some pretty major strategic news right at the top of the call.
That's right. Max Levchin kicked things off, announcing a really significant extension of their foundational U.S. agreement with Amazon.
Foundational is the word.
Yeah.
And not just a small renewal.
Right? No, extended for another 5 years.
Wow, 5 years. So that pushes the contract out to January 2031.
Yeah.
I mean, for you listening, that's basically the definition of stability in a core channel.
It really is. It locks in that relationship for, the next half decade.
Which absolutely frames this whole conversation we're about to have about their strategy, their balance sheet, everything.
It does. So our mission today is really to cut through maybe some of the corporate speak and figure out what this stability actually buys them. We're looking at how they're diversifying distribution beyond just the giants, why their financial execution seems to keep outperforming, and what their super specific data is telling us about consumer health right now.
Okay, let's unpack that. Starting with those strategic foundations. The Amazon extension is massive, obviously.
Huge.
But listening to the call, it's clear they know they can't rely on just one channel, even one that big. It's a risk. So they talked a lot about scaling distribution through payment service providers.
PSPs.
Yeah, PSP is kind of the backbone for expanding quickly these days. They announced signing the WorldPay platform.
WorldPay, right.
Which might sound like just a technical detail, but it's actually crucial. It hits that core challenge of scale.
Yeah.
How fast can you integrate?
So why do PSPs matter more than, say, direct sales teams? Is it just speed?
It's speed and it's ubiquity. Affirm wants, as Levchin put it, lots of doors with Affirm logo on all of them.
PSPs give them that fast track. If a big e-commerce site already uses WorldPay, Affirm can plug in way faster than building a custom connection every single time.
Oh, okay. So it massively reduces the friction for merchants to adopt Affirm.
Exactly. PSPs are basically infrastructure multipliers. Affirm gets integrated faster across tons of merchants, but they still handle the specialized sales and configuration part themselves.
Got it. And this faster integration, this infrastructure, that helps them reach smaller merchants too, right? The long tail.
Precisely. And the prime example they gave there was Shopify. Shopify is just this massive distribution partner connecting them instantly to that huge network of smaller businesses that also need flexible payment options.
Okay, so stability with Amazon, speed through the PSPs, and then scale with platforms like Shopify. It sounds like a pretty comprehensive distribution plan.
It does.
So if they've got all these doors opening, let's maybe shift from doors to dollars. Let's talk financial health, especially around capital markets.
Yeah, listening to the call, what really jumped out was their resilience in funding. The team mentioned industry difficulty. I think some analysts call it the tricolor situation.
Right, the tricolor situation. That's rising rates, rising credit losses across the board, and tighter bank liquidity, all happening at once.
Exactly. But despite that really tough environment, Affirm managed to successfully execute another ABS deal recently, asset-backed securities.
So how are they doing that? How are they funding themselves successfully when others are clearly struggling?
It seems to boil down to two main things. First, they're expanding relationships with what they call blue-chip forward flow buyers.
Okay, unpack forward flow buyers for us.
Yeah. So these are big institutional investors, think large banks, maybe pension funds. They basically commit upfront to buy a stream of a firm's future loans at a set rate.
So it gives them stable, predictable funding outside the normal ABS market volatility.
Exactly. And the second factor they point to is just the inherent quality of their asset, the loans they create.
The unique value of those loans.
Precisely. Because their underwriting is so disciplined, the loans perform really well. That makes them highly valued in the debt capital markets, especially compared to, similar stuff from competitors who might be less rigorous.
Okay, that resilience makes sense. And we need to keep that in mind when we talk about their main profitability metric, RLTC, revenue less transaction cost.
Right. RLTC for Q1 was around 4.2% of GMV, gross merchandise volume.
But they have a very specific philosophy about that 4.2%, don't they? It's not just about maximizing it.
They do. They actually see 4% as the upper bound for RLTC. Their long-term target is really 3% to 4%.
Wait, so if they're running above 4%, they actively try to bring it down. That seems counterintuitive.
It does, but it's a crucial strategic point for you listening. If they're consistently above 4%, they deliberately look for ways to expand the network. That usually means lowering the financing costs slightly or offering more generous terms. They prioritize growing GMV and user reach over just maximizing that short-term margin.
But hang on, if capital markets are shaky, like we just discussed, isn't consciously trading away potential margin for more GMV a bit risky? Why not just bank that higher 4.2% now, build a bigger cushion?
That is the critical question, right? And their confidence really comes back to that asset quality we talked about.
Okay.
And the belief that scale itself is defensible. They're basically arguing that once they hit their desired scale, the operating leverage will really kick in hard. So they're using their current financial strength, essentially, to subsidize getting more users and more merchants on board. They're saying, look, our underwriting is so good, we can afford a slightly lower take rate if it means we grow faster.
Okay, that makes sense. Playing the long game. We saw a related point in their Q2 guidance, where RLTC is expected to dip slightly closer to 4%. Was that an example of this strategic trade-off in action?
Well, not quite in that specific instance. They flagged a particular factor there. One single major merchant program had a very high proportion of long-dated 0% loans. And naturally, if you offer a loan that's 0% interest and stretches out, say, 12 or 24 months, the effective revenue you get from it drops quite a bit.
Right.
So that dip wasn't systemic. It was just a calculation tied to the structure of that specific big partnership.
Yeah.
It actually kind of confirms they're committed to managing the platform around that 4% upper target.
Gotcha. Okay, on the positive side of the financials, they significantly boosted their full-year guidance for fiscal 26 operating margin. Went from over 6% to now over 7.5%. What's driving that better leverage? Is it cost-cutting? Layoffs?
Well, what's really encouraging here is that they explicitly said this leverage is coming from growth, not cuts.
Okay, that is encouraging.
It means those incremental RLTC dollars, the profit from new sales volume, are flowing down to the operating income line more efficiently than operating expenses are increasing. It really signals that their tech investments and their scale are starting to pay off properly, in a healthy way.
That leads us perfectly into maybe the most interesting part, the consumer and the data behind all this. Affirm stated their own data shows the spending environment for their specific customer base is, quote, pretty damn healthy.
Yeah, but this is where we need to dig a bit deeper, right? Is that just because their underwriting, which they call highly unnatural and mathematically built, is just cherry-picking the absolute best customers.
Or is the broader environment actually okay?
Exactly. And they give this really fascinating anecdote to show just how sensitive their macro monitoring is.
Ah, the microeconomic test. Yeah, that detail was incredible.
It really was. Lefton talked about how they analyzed data specifically from government employees during that brief period when a shutdown was looming.
Okay, just federal workers, that's a tiny slice.
Tiny, localized group.
Huh?
And they saw two things. First, good news. No change in delinquencies or defaults within that specific group, even with the uncertainty.
Okay, resilient.
But second, and this is the key part, they did detect a slowdown in demand. Just a few basis points, but measurable. Those employees were pulling back slightly on making new purchases.
Wow, so they could detect a tiny spending dip among a microscopic demographic facing temporary uncertainty. That's a serious data advantage.
It really proves two things, I think, for us as analysts. One, the consumers they serve, even under a bit of short-term stress, seem pretty resilient.
Right.
And two, if their models are sharp enough to pick up such a tiny, localized negative signal, well, they must feel pretty confident they won't miss a broader negative signal if the overall economy genuinely takes a downturn.
And that really robust, responsive underwriting system, that's what lets them push into these complex new areas, right? Like services, elective medical, auto repair, sectors that are usually tough for automated credit models.
Yeah, how did they do that without years of historical data in those specific fields? It's all about incorporating new signals quickly. Traditional underwriting often relies on pretty static data points. Affirm's system seems advanced enough that they can rapidly feed in totally new data streams.
Like what kind of streams?
Like detailed descriptions of the actual services being bought, not just generic merchandise codes or SKUs. Being able to analyze the specific nature of the service transaction itself, that seems to be the key to unlocking confidence in these new, more complex sectors.
Okay, let's just gear slightly to the product that's really driving user reach. The Affirm card. Another 500,000 card members added just this quarter.
Yeah, steady growth there. And their strategy for the card is interesting, too. It's not about external marketing campaigns.
No.
No, they're marketing it entirely internally, just to their existing repeat customers. It's basically an upsell tool for their core engaged user base.
And the tech behind that expansion, they call their cash flow underwriting an unlock for growth. Why is that specific tool so powerful right now?
It directly tackles how consumer behavior is changing, especially with younger millennials and Gen Z.
How so?
Well, these groups are often actively trying to avoid traditional credit card debt, right? Which means they might have thin or limited traditional credit files, even if they have good income and savings habits.
Okay.
Cash flow underwriting lets Affirm, with the user's permission, of course, look directly at their actual bank data, see their real recent spending patterns, their savings.
So they can confidently approve prime customers that old school credit scores might miss entirely.
Exactly. It's unlocking this huge pool of prime younger consumers who just look different on paper. They've set some ambitious goals for the card, too. 10 million active members, aiming for $7,500 per year in discretionary spending per member.
And where are they on that spending goal?
They mentioned they're about 1/3 to maybe halfway towards that $7,500 annual spend figure already.
Okay, significant progress. Finally, let's circle back to the 0% APR strategy. They said they intend to lean in very heavily on these zero-interest products. Why the big push there?
Well, it does a couple of things. It definitely attracts customers with higher credit quality, people who are maybe more debt averse, and it just rounds out the overall value proposition for the consumer.
But lots of places offer 0% financing. What makes Affirm's different? They seemed really emphatic about this.
This is their core competitive differentiator, they argue. Levchin was very clear. He said they're the only provider offering an honest and true transparent 0% offering.
Okay, honest and true transparent. What does that actually mean? How is it different?
It boils down to the lack of hidden fees or penalties. Their 0% loans have no late fees, no reminder fees, and crucially, no snooze fees if you need to adjust a payment slightly. It is genuinely 0% interest with absolutely no strings attached if you pay on time.
So that transparency is the key. That's what attracts the high-quality borrower who actively avoids the traps of traditional credit card revolving debt.
Exactly. And they showed how powerful this can be with that 0% days promotion they ran. Jokingly called it the Big Nothing Day.
Right, the Big Nothing Day. What was the strategic goal behind that promotion? Just to offer deals?
It was more about proving a point, actually, proving it to merchants.
Okay.
They wanted to demonstrate that Affirm can actively drive demand for merchants, using targeted promotions through their app and the card. They're not just sitting at the bottom of the checkout funnel, passively fulfilling demand that was already there.
So it positions them as more of a marketing partner for retailers, not just a payment button.
Precisely. Especially since, apparently, a huge chunk of those 0% offers were actually funded by the merchants themselves, effectively acting as a targeted marketing spend for them.
Okay, so let's try to synthesize this for you, the listener. We started with that long-term strategic stability. Right?
Yeah.
Locked in by the Amazon extension, boosted by the scaling efficiency from PSPs.
Right, and that stability allows for really disciplined financial management, hitting that 4% RLTC target, which then fuels that impressive operating leverage that's based on growth, not cuts.
And underpinning all of that is the technology. That highly granular data, proven by the government employee test, lets them monitor consumer health with incredible precision.
And they're using innovations like cash flow underwriting to reach massive, underserved groups like Gen Z who don't fit traditional credit models.
So I think the core takeaway here, for you, has to be understanding that transparency isn't just a marketing buzzword for a firm. It's fundamental to their business strategy.
Yeah.
That difference between their truly zero-fee, 0% offer and what others might market, that's what lets them scale confidently and attract those higher quality customers who demand honesty.
Exactly right. You could argue it's the competitive moat they're digging right now.
And speaking of moats, that data moat, the ability to spot a spending dip in such a tiny specific group like federal workers, that shows an almost scary level of sensitivity.
It's pretty powerful stuff.
So, as a firm keeps feeding this incredibly granular transaction data, this service data, into new complex areas, like elective medical, like auto repair. Here's a final provocative thought for you to chew on. How is this capability going to fundamentally change the game for risk assessment across all of consumer finance? What does it mean for traditional lenders relying on much blunter tools? Will they have to drastically accelerate their own tech or just risk getting left behind?
They're basically setting a whole new bar for precision in lending. It forces everyone else to react.
Definitely something to watch. And that's where we'll leave our deep dive for today. Thanks for joining us.
Talk to you soon.